I'm pretty sure that we are going to but we shall be talking about IS 38, and that talks about intangible asset, how to account for intangible assets. And then IFRS 5 talks about non-current assets held for sale and discontinued operation. So we can start with the IS 8, and that talks about intangible assets. Like I always tell you, please always bring your writing material to class. Make sure you jot down something. So let's quickly start. IAS 38 that talks about intangible assets. Summarily, it's trying to describe to us how to account for, whatever that we call an intangible asset. We know that intangible assets, they do not have what we call a physical form. That is, you cannot see them, you cannot touch them, but you cannot deny that they exist. And so this standard gives us an overview as to how we should treat any item that is being considered as an intangible asset. So IAS 38, in summary, ensure that only genuine intangible assets are recorded as well as reported consistently and in a reliable manner. In other words, IAS 38 tells us what exactly to be recognized as intangible assets and how to treat them in our books. So that is the overview. Now, let's proceed by looking at the definition. What exactly is intangible asset? We have been hearing intangible asset, intangible. What is intangible asset? According to IAS 38, intangible assets, they are assets of non-monetary value that are also identifiable, controlled by an entity to generate future economic benefit. That is to say, they are monetary in their nature. They are identifiable. It means when we say non-monetary, it means they are not. They don't have cash form. They don't have cash formation, and they are not something that you can see somebody is owing you or that you are owing somebody. You understand me now? So that's why we say you can't quantify them in monetary terms. And number two, they must be identifiable. In other words, you can see them. You cannot see them. You cannot touch them. But the availability in a business is undeniable. Is undeniable. Like buildings or equipment or your generator, motor vehicle, you can see them, you can touch them. Those ones are referred to as intangible assets. But the intangible assets, you cannot see them, you cannot touch them, but you cannot deny that they exist. You can only feel them. And that is why they are called intangible assets. Please confirm again if you can see my screen. Okay, thank you. So for you to call them an intangible asset, it means that you can identify it as an entity. You are correlating as an entity. And they are capable of generating future economic benefits. In other words, they can, when we say future economic benefit, generating future economic benefit, it means that they can increase your revenue, they can help you to save costs, or improve your operations as an entity. So that's why we call it, that's why we say they can generate, they must be able to generate future economic benefits. So Summarily, intangible assets, they are non-monetary identifiable assets controlled by an entity and generating future economic benefit to the entity. And so these key words must be in your definition. That's why I bring it out. I call it the ICC. ICC, that is, it must be identifiable, controlled by an entity, and capable of generating future economic benefit. So that is what you need to know. And what are the examples of these intangible assets? Quite a number of them. We have the masthead, your patent, your license, software, which other one again? Copyright. All of these ones, they are types of intangible assets. David, you are raising your hand. Okay. Please mute your video. We don't want to be seeing you. Now, what are the types of intangible assets? Please mute your video. Let us see what is not applicable. Types of intangible assets. ISA 8 categorize the types of intangible assets into two. We have the externally generated intangible assets as well as the internally generated intangible assets. Externally generated intangible asset means assets that are being purchased, that is, intangible assets that are being purchased outside of an organization. That is to say, they are purchased by an entity. They are purchased by what? By an entity. Examples are software that you purchase, patent right that you purchase, license that you purchased, or trademark that are purchased. All of these ones, they are examples of externally generated intangible assets. In other words, you do not generate it within your operations. They come usually by you paying for them. For instance, the software that are being used in the bank, those that are working in the bank, I think we have Bank One and the likes. Those softwares are being purchased. If you look at the software as it were, you cannot see them. You cannot touch them. But you cannot deny that they exist in your business. You understand me now? So that's why we call them identifiable. You can identify them. And you control them. The use of the software is being controlled by you because you can use it at will. I'm talking about a software in the bank, for instance, just using that as an example. You can use it at will. Then also, the use of that software is helping you to save human costs, as it were, because what the software will do in 2 minutes, if you should use the human resources, it will take a longer time and will require more human resources. So by that, it is reducing your cost of human engagement in your operations. So that's why we say intangible assets are usually identifiable. They are not monetary in nature. They are identifiable, and then you are controlling them. An entity controls them, and then by the control that the entity have over them, they are used to generate future economic benefit. And like I said, the types of these intangible assets are being categorized into two: externally generated intangible asset and the internally generated intangible asset. Why do I want to separate it this way? So that it will help your understanding. And why is this so? Every externally generated intangible asset are meant to be capitalized as long as you can identify them and you know that an entity controls them, that is the use of them, and then you know that the entity is using it to generate future economic benefits. So that is that for that. And how do you treat it in your books? Every, like I just mentioned now, you capitalize all the externally generated intangible assets. How? By recognizing them at their initial cost. And just like we have tangible assets, when we get to recognition, we may understand it better. Just like we have a tangible assets that you recognize at the initial cost, the same thing you recognize intangible assets at their initial cost. And the initial cost will always be the purchase price plus any directly attributable cost, like your legal fee, professional fee, and the like. So whatever cost that is involved, you recognize them. And then after your initial recognition, your first year carry amount will be the asset. Will be cost minus amortization minus any impairment, and that will give you the carrying amount. So this is called the cost model. Don't bother yourself. When we get to recognition and measurement, we'll discuss it further. Just need to bring this up so that you know it is being done. So, but please take note. Every externally generated intangible asset are to be capitalized. As long as you can identify them, and then you know that an entity control them, and then they are being used to generate future economic benefit. So that is the first categories or types of intangible asset. The second one is the internally generated intangible asset. That is, they are created within the organization. They are created within the organization. An example is software that is developed in-house, products that are being created internally, your processes that are being developed internally generated goodwill, brands that are generated internally, customers list, advertising, training, setup costs. All of these put together, they are all internally generated intangible assets. And so, but please note, not all internally generated intangible assets can be capitalized. In other words, all internally generated intangible assets are to be expensed. That is, they are not to be capitalized until they are being identified in the development stage. In other words, we have two stages under the internally generated intangible asset. There are two stages that are involved for you to generate intangible assets internally. There are what? Two stages involved. So we have what we call the research stage, and we have what we call the development stage. Now, every internally generated intangible assets that do not surpass the research stage, they are to be expensed. Please note that down. Whatever that constitute themselves as internally generated intangible assets that are within the circumference of research stages, all of such intangible assets must be expensed. In other words, you are not going to recognize them in your statement of financial position. That is, you cannot capitalize them. Rather, you are going to expense them, and that will be in your statement of profit or loss. Rather, you are going to carry them as an expense item in your statement of profit or loss. So we have the research stage, like I said, and we have what we call the development stage. The research stage is the stage that you ask questions. What do we do? How do we do it? Where you make all kind of investigation before you come out with the final product. Whatever cost that being carried out at that point in time is meant to be categorized and put under your expenses. They are not part of the cost of the asset. When we say capitalize, it means cost of an asset. And when we say expense, it means expenditure made on the asset. There are two clear differences between expenditure made and then capital expenses as it were. We have what we call the operating expense and what we call the capital expense. So capital expense, they are meant to be under your asset. Operating expense are meant to feature under your under your profit or loss account. So it's as simple as that. So all costs that relates to research under the research stage are meant to be expense. Examples are your market investigation. For instance, you go to the market to survey customer to know what kind of product do they want. You do visibility study, you do your market research report. Any amount that you spend on that, you are going to expense them. What about concept development? You want to develop a concept. Please take note. You want to develop a concept. You now brainstorm. In your brainstorming, you call your friends, your colleagues, you sat down, they bought biscuit, they bought a Coke in the presence of you brainstorming, and the likes. You did your refreshment. You know, they did what we call sketches of early design. You test different ideas. You test it here, test it there. That does not mean that the concept will become a reality. That's why we say, up, not if you are not certain. Well, we get there. When we get to the development stage, you will understand it. If you are not certain that the idea will become a reality, anything you spend in that point in time, they are not cost to be capitalized. They are meant to be expense. That's what we are talking about. What about laboratory or technical exploration? Like you are trying as an experiment. That you are trying an experiment in lab do not make it a product yet. Eh? So all of these are going to be expense. What about training of staff? I've mentioned it in our previous classes. Staff professional fees, for instance, salary of research staff, consultancy fee for idea evaluation, payment of scientists or engineer at the research stage. All of these are meant to be expense. Data collection, going to the market to collect data. What do they need? Purchasing material, purchasing research material. What would they want to get and the likes? All of these are to be expense. So also we have the early software investigation stage. All of these also are meant to be expense, like studying the program's option, testing the platform, writing trial codes. All of them are what we call research expense. They are all meant to be expensed. So what I have put down here is what I call the simple rules to guide you. Number one, always ask. If they call it an intangible asset, ask yourself, can this be done? In other words, this is the stage that we will ask, can this be done? Will the project become a reality? Will the concept become what will be worked with? Always ask. Is the idea workable? Always ask that question. If you know that it will not move from that stage where it is, all the expenditure are meant to be expense in your profit or loss account. Then we have the development stage. Development stage is the stage whereby you know that whatever you have put down in the research stage will become a reality. Will become a reality. Applying your research to produce a usable asset. That is what we call the development stage. So most of the costs here can only be capitalized if all of the following 6 criteria are met. You can only capitalize any cost at development stage if all the following 6 criteria are met. Remember, I said development stage is at the stage that you know too well that the product or the concept will become real, will become a usable asset. Let's use that word now technically. So number one is that if for you to capitalize any cost, number one, it must satisfy that it is technically visible. In other words, you know that the reality of this product is real. That is number one. Number two, the intention to complete it is visible. You are seeing it. You are satisfied that there is an intention to complete it. Not that you intend to complete it and you do nothing about it. You intend to complete the project. That is the second criteria. Number three, you know that after completing the project, you can use or sell the product. It's very, very important. Or the project. Use or sell. Ability to use or sell. Then, four, future economic benefit is highly probable. That is the probability of getting what we call future economic benefit is probable. When we say future economic benefit, it means addition of revenue, savings of cost, or improvement of the operational efficiency of the entity. If this is visible, then you can capitalize the cost. Then another one, of course, is adequate resources are available. Then the last one is the costs are reliably measured. If this number 5, you may leave it, but the key ones are number 1, technically visible. Number 2, the intention is there. That is to complete the project. Number 3, ability to use or sell the product after it is being completed. Number 4, future economic benefit is highly probable. And number 5, cost can be reliably measured. All of these, they are what I call the conditions that must be fully met. So I have an acronym for it. That is, I call it CAVIT. This is what I call it. CAVIT, please don't forget. CAVIT. C stands for the cost and reliability measure. A stands for ability to use. F stands for future economic benefit. I stand for intention. T stands for technical ability. Please take note of what I have just said. So you can as well add your A if you want to call it carpenter, carpenter, or carpenter. You know carpenter now? The carpenter, they call them carpenter too. So you can remember in your exam hall, carpenter. In case you forget, always remember carpenter. So that is how it is. Please, all of these 6 conditions must be met before you can categorize them as a cost to be capitalized. Now, you must understand that your question may come direct, your question may not come directly. So it is you that must use your logical sense, or based on what I have explained so far, to determine what exactly is to be capitalized or what exactly is to be expensed as an intangible asset cost. The essence of why you are also in this class is as simple as that. But look, please note again, if any of these conditions, anyone fail, if at least the 5 that I said, that's the CAFIT, must be present. If the 5 are present, then you can capitalize the cost. But if one of the 5, that's one of the CAFIT, is missing, you cannot capitalize the cost. You have to expense it. And this is one of also one of the major critical area of concern when it comes to measuring intangible asset, because technically visible may be there, intention to collect may be there, ability to use may be there, future economic may be there, cost will be reliably measured. And then, but if one is missing, why would you say we should not capitalize it? Well, that is in the wisdom of IS 38. But then also, if we look at it logically, it makes sense to say that all of these 5 criteria must be satisfied before we can capitalize the cost, as it were. All right. Before I take question, let's look at the examples of development stage when it comes to internally generated intangible asset. We have an example of the software that we develop internally. Like now you have done research that, well, like I said earlier, you have done research. Will customer want to use the software? Will it be suitable? All of those ones you expense the cost. But for you to now say you want to capitalize the cost, look at it this way. When you begin to write the final software codes, yes, at this stage you know that the software is sound for use. Or when you are paying a programmer to complete the system, that is to design the system, not design it now, to make the system workable, usable. Then, when you test the finished software before you launch it, that cost can be capitalized. Installation of the developed software, that cost of installation can also be capitalized. We also have product design and construction. Designing the final product, the cost of it can be capitalized. Producing working prototypes, the cost can be capitalized. Engineering costs to complete the product, like you pay the engineers that develop the product, you pay the professionals, you understand, at that development stage, they are directly involved. Those ones can be capitalized. Capital simply, they are what we call somebody is asking what is capital. Capital. It simply is the acronym for the creditor that must be satisfied before you can capitalize any intangible cost. That is internally generated intangible cost before you can capitalize it. Now, if the reason why I'm stressing this is this: every internally generated intangible asset are meant to be expensed. But if it gets to the development stage, usually you will see something like in your question, they will say they intend to come up with a product on 1st January, they spend this on July 2nd or on July 1st. It was certain that this product will now be used. That stage, on 2nd of July, is what we refer to the development stage. Let me come again as an example now. You will see in a question they will say on 1st January 2026, this also company come up with the idea of setting up a software, and the committee was set up. In the committee, they brainstormed, and then there were refreshment that was taken, that they took refreshment, and then they did the research. They check all the customers, what can they do, and the like. So all of these put together is the beginning of how the idea is going to come to be. But the idea is not yet in place, it's not yet certain. Therefore, every expense at that point in time must be taken care of in the statement of profit or loss as an expense. But then you now go for that to say on 1st of July, that 2026, it was confirmed that the product or the project will be completed. That point in time becomes the development stage. You now hear something like on 31st of December, the product is being put to use. So between that 1st July to 31st of December, that cost that is being expensed is what will be called internally generated development cost, and then that cost must be capitalized. That's what I'm trying to explain, and I'm sure you understood it now. So we have quite a number, like I said, example of your internal generated intangible asset types of it. We have the development stage, software developed, product design and constructed, production preparation, staff cost. Yes, I want to talk about the staff cost because I told us earlier that some staff costs are not to be capitalized, especially with training. But look at this: salaries of the developers and the engineers, technical staff directly working on the assets. All of these are staff costs that must be capitalized. Professional fees, I've talked about this before now, like paying of consultant to complete, not to verify. That you are paying a consultant to check the viability of a product does not mean that the product is going to come to pass. But when you now pay a consultant for completely developing the product, then you can pay for their service. A lot of technical advisory fee that relate to the final design, the ones that relate to the final design, always check it very well. So all of these are to be capitalized. Equally, testing before commercial use, like this they call it performance testing or quality control testing. For those that are working in the manufacturing industry, this will be very much they can relate to this one very well. They call it performance testing or quality control testing. That is to be sure that the product can actually be modified, be used, or if there is any issue to it. Now, at this stage in time, they have already produced the product, as it were. They have created the product. Now, performance testing simply means they are testing. They will ask you, how do you see it? How do you see the taste of it? Is the sugar too much? Is it lower? Should we add sugar and the likes? All those are called performance testing or quality control testing. All of those costs that emanated from there, they are what we call costs that can be capitalized. It's as simple as that. Any questions so far? Do we understand it now? I'm sure we do. Any question? Can I ask my own question?
Please, the meaning of the carpenter, please.
Okay. Capital simply means the C stand for, who can tell me what the C stand for?
Cost can be measured. Cost can be measured.
Cost can be measured. A stand for what?
Ability to use or sell.
Ability to use or sell the asset. F stand for what?
Future economic benefit is highly probable.
The probability that the future economic benefits will accrue to the entity is highly probable. Then the I stand for
Intention to complete.
intention to complete. And then the T stand for
Technical feasibility.
technically visible. Then the A stand for availability of resources. That's what we call it capital. Don't forget, please.
Thank you, sir.
All right. So that is that for that. So recognition now. There are 4 criteria that must be met before you can recognize an intangible asset and in the financial statements. All of the 4 must be met. Number 1, the intangible asset must be identifiable. identifiable. Number 2, entity must control it. Number 3, there must be what we call future economic benefit. And number 4, the cost must be reliably measured. The cost must be reliably measured. The cost must be reliably measured. So that is the 4 criteria that must be fully met before you can recognize intangible assets or the financial statements. Identifiability, control, future economic benefit, and then cost being reliably measured. Cost being what? Being reliably measured. So you can put it as what do we call this one now? I have not put acronym for this, but please, you should know it offhand. This should be something that should be ringing in your head. Future economic benefit. Generate that is revenue, cost saving, or and efficiency. Control. The entity is controlling and have at least, the power to use the asset the way they want to use it. Say, for instance, the license that is being given to audit firm, the practitioners, that license, you can't see it. Is that not so? You can't touch it, but you can. Somebody have given me. No, I won't use. I would rather use freak instead of the acronym. I would rather use freak. Freak is better. So that is under intangible asset. Thank you. Freak is better, and I think I go with that. So what I was trying to explain earlier, license that is being given to the auditor, give them the right to, stamp and seal and prepare an audit report. But you cannot see that license, you cannot touch it. But you cannot deny that it is helping the auditor to get what we call revenue. That is what we call future economic benefit. And because the auditor also have that license, meaning he has control over how he will audit, having gained what we call professional competence, and in doing so, the license has given him the power to be able to determine how the scope of his work is going to be. Unlike somebody that does not have an audit firm, you cannot determine how an audit work is going to be, but an auditor can determine how it is going to run. So I'm just giving an instance now. So understand that FREAK stands for future economic benefit, R stands for reliability of the cost being measured, I stand for what? Identifiability. You must be able to identify the intangible asset, and then the C stands for what is that C again?
Control.
Control. Sorry, yes. You can control it. So FREAK is there. That's that for that. So measurement now, just like we have for tangible asset, we also have for intangible asset the measurement. It is measured at the initial as well as in the subsequent. So we have initial measurement and then the subsequent measurement. The initial measurement is just like we have it under the tangible asset. You have it under this intangible asset. The purchase price plus import duties and non-refundable taxes plus legal operational fees and any other directly attributable costs necessary to prepare the asset for use. Necessary to prepare the asset for use. It does not include the research stage cost. It does not include any cost before the development stage. That is the initial measurement. Then the subsequent measurement is you can either use two models, just like you have it under the tangible asset. Two models are applicable. You can use it, either the cost model or the fair value model. And the cost model is the historical cost of the asset, of the intangible asset, minus accumulated depreciation, minus any kind of impairment will give us the current amount of the intangible asset at the financial year end. And then the fair value model talks about you comparing the current amount of the asset with the prevailing market price. That is the fair value of the asset. However, for this intangible asset, you must understand that it is always advised that you use the cost model. Why? Because the fair value of the intangible asset may not all that be available. The data may not be available all the time. Why do I say so? For instance, you may not be able to quantify what the market price of what is it called now? Copyright is. You cannot say, okay, the copyright in this also place is this amount. You understand me now? The market value of a copyright, you cannot determine it. And, it's part of externally generated intangible assets. So that's why we always advise that you use the cost model. And the cost model is the cost of the asset minus minus accumulated depreciation minus impairment. It's as simple as that. Very, very simple and cheap as it were. Then the disclosure that are required. Number one, you must be able to disclose the class of your intangible asset. In other words, are they internally generated intangible asset or externally generated intangible asset? You must disclose it. Number two, the useful life or the amortization rate that is being applied. So understand equally before I go further that amortization is just like depreciation. But you can only depreciate tangible asset and amortized intangible asset. They are almost the same thing. They mean the same thing. It is what is that definition of depreciation now? Systematic allocation of the cost of an asset over the useful life of the asset. It's the same thing as systematically allocating the cost of the intangible asset over the useful life of intangible asset. That is the meaning of amortization. So please, amortization method that is used or the rate that is being used is very important for you to note. Now, also note this. There are two methods. Just like you have under the tangible asset, there are two methods that can also be used for amortization. Either you use the straight line method or you use the reducing balance method. That is, they will give you a rate. The reducing balance means that you are being given a rate. You understand it now? So once you are given a rate, you apply the rate, and then that will be on a reducing balance basis. So that is how it is presented. Then you must tell us the amortization that you use. If you use the straight line method, you let us know. If you use the amortization rate, this reducing balance rate, you will let us know. Then what are the current amounts at the beginning and the end of each of the year? You must tell us, disclose it. Then if there are any additions during the year, disposals or impairment during the year, you must also let us know. If there are also any restriction, if there are any kind of restrictions, you must also let us know. Very, very important. All of this disclosure, they are what promote what we call transparency, and then they help decision making of whoever is using the financial information that you have given out. So that is it. Everything that you need to know under intangible asset. You need to know the definition, like I said. They are non-monetary, identifiable asset controlled by an entity to generate future economic benefits. And like I said, they can be categorized into two: internally generated and externally generated intangible asset. And I said, for the internally generated intangible asset, they must all be expensed, except if they have gotten to the development stage. In other words, if you are generating the intangible asset internally, we have what we call the research stage. If your expenses or your costs were all in the research stage, all of those costs must be expensed. But once they get to the development stage, they must be capitalized. And I told you that for you to capitalize any cost at the development stage, they must satisfy what we call capital. Now, this is a capital criteria. What is that capital? That is to say, the costs are reliably measured. What is the A? Availability of resources. F, future economic benefit. Or the other A can be ability. Anyone you can put it if you remember. The intention to produce is there. And then you have the T to be technically visible, and the other A to be the ability to use or sell the product. So that is that for that. Then the external generated goodwill. External generated intangible asset, they are the one that you buy, like your license, your copyright, patent, and the likes. They are externally generated. So all of such must be capitalized and is recognized in your book. It's as simple as that. And then we move from there to talk about recognition. And then I told you that 4 criteria must be met, and that is FREAK. And F stands for future economic benefit. R stands for reliably measured, right? I think so. I stand for identifiability. Then C stands for control. FREAK. Very, very important that you should note it. Then for the measurement, I said we have the initial and the subsequent measurement. The initial measurement is what we call that is identifying the historical cost of the asset, the cost at the beginning of the life of the asset. And I said it is usually the purchase price plus other directly attributable expenses that have met the required criteria. And once you're able to do that, the subsequent measurement always takes place at the end of the beginning, of the first year of the asset. In other words, you have to let us know what the current amount of that asset is. And for you to be able to determine the current amount of the asset, you must be able to identify the useful life of that intangible asset. And so you can use 2 models to actually do what we call subsequent evaluation of the intangible asset. And we have the cost model and the fair value model. And the cost model has to do with you being able to identify the historical cost of the asset. If it is first time of adjustment, if it's first time of evaluation, historical cost of the asset minus the depreciation, minus any impairment that might have come in the process of you being able to operate within a calendar year. So you must be able to also identify that. That will give us the current amount of that asset. And then the second model is the fair value model that looks at the market price of that can be compared with the current amount of the asset. So please take note, like I said, the fair value may not be a good means of doing a subsequent measurement. And so please, you may not see it in practice. Please, you may not see it in practice. And we'll go ahead to talk about disclosure. And I said, things to disclose includes the following. If there are any additional disclosure.
Excuse me, sir.
Maureen, just hold on. Amortization method used, description of each of the class of intangible assets, as well as the useful life and other disclosures. That is that for that. Before we go into illustration, Maureen, you want to ask a question? Go ahead.
Yes, sir. You did talk about two ways to in the subsequent measurement. Yes, you talked about cost model and fair value model. Am I right, sir?
Yes.
The fair value, can it also be referred as revaluation model?
It's the same thing.
Okay, sir. Thank you.
All right. So that is that for that. Are we all clear? Any question? I think it's very clear. I've done justice to even me. I know I did it. I tried. Abi, clap for me now. But for me to know that you have understood it, we have to do this illustration together. Now you can snap it so that we can easily and quickly do this illustration together. Look at the following. They said the following costs were incurred by Elegant System in relation to a new marketing software in January 2017. Market research to determine user preference 250. That's the cost. I've told you once you see a question, the first thing to do is to do what? Go and read your require. So let's go to require. Require. Classify the above costs into those that should be recognized as assessments and those that should be capitalized under IS 38. B. State the condition that must be met for capitalizable costs to be recognized in your books. You can see it there. So can we quickly attempt this question, or we should do it together?
Let's do it together, please.
Let's do it together.
To save time, let's do it together, please.
Let's do it together.
Okay? Solution. He said we should do what now? Classify. So let's do the expense. Expendable cost. Now, looking at this question, the market research to determine the user preference, is it a cost to be capitalized or expensed?
Expense.
When you are telling me, you raise your hand, or when you are talking, give me a reason. Why should it be expensed?
Because at the researchable stage.
Thank you so much. That the research stage. Concept development and testing. Is it to be expensed or capitalized?
Capitalized.
Capitalized.
Oh my God. Do we all agree is capitalized?
Yes.
Oh my God. That means
It's at its final stage.
that means the cloud that you people gave to me earlier, I will return it back to you.
Excuse me, the concept development and test is expense.
Why?
Expense because it's under research and whatever.
Please help me clap for this, auntie. Maureen, thank you so much. They say concept development. You are developing the concept and you are testing it. You are developing the concept. It's not yet it's not yet a real product. It's not yet a final product. This is why I want you to be thinking logically. That's why I say ask that question. Concept. You are developing a concept. Is it something that they can use now or that they will use? So always apply that capital criteria. Please always apply it. Is it technically visible? Is there any intention? Is there any ability to sell or use? Do you understand? Is there any available resources to take care of it? Please, I'm begging you people now. Number 3, pilot version testing.
Expensive.
Why? Because
It's still in research stage.
how is it in research stage?
We don't know if it will work. Might not be
Because they are just test running it.
They are just test running it. You don't know if it will work. So clap for yourself now, everybody. At least my man, calm down small now. Okay. The next one. Is it to be capitalized or
Capitalized.
Why? Because it is the cost of the final stage, right?
Yes, sir.
Thank you. The next one, is it to be capitalized or expensed?
Capitalized.
Oh, yeah, give me the answer.
Capitalize it. Salaries of developers, right?
It's capitalized, oh.
To be capitalized, sir.
Okay.
It's capitalized.
Wait now. So meet your mic. Let's discuss this very last one. Let's discuss it very well. Staff training on the new software. Is it to be capitalized or expensed?
Expense.
Expense.
Why?
Okay. Now let me say this clearly now, so that you won't get yourself bothered. Any training cost at all, for any reason, whether final stage, winning, whatever, any training cost must always be expense. Any staff training cost, they must always be what? Expense. If you were in the last class, I think I said something about this staff training cost. Any staff training cost must be expense. And I told you the reason. Usually, you can, because you train a staff today, do not mean that the staff will remain in your organization tomorrow. You may train the staff to use the software today. The salary you are paying the staff may be 200,000. If you get someone that will pay him 400,000, will it because of your software and remain in your organization? No, it will go. So every staff training course must be what? Capitalized. I mean, must be expensed. Sorry. Is it taken now? So based on this analysis now classify it. Let's know what are the expendable costs. Let's go.
Market research.
Concept development and testing.
How much is that?
300.
Which other one?
Pilot version testing. 200.
Which other one?
Staff training on a new software.
Staff training on the new. How much is it?
120,000.
Total. Any other one?
70,000.
870,000.
Can anyone try? So that's our assignment.
What did you say?
Are we still together?
No, sir. What's the assignment?
I asked a question. I said, can you see my screen?
Yes, sir.
Can see it.
I'm asking a question that what would be the accounting treatment for this?
Your expense to
It will be expense to profit and loss.
Tell me as a professional, where will you debit? Where will you credit?
You debit the expenses.
Credit where?
research and development.
So that's your assignment. Okay.
Hello, sir.
Go ahead.
We debit the P&L, then we credit the bank account.
Please let me clap for this. Let me clap for him. I'm giving you 5 marks. Five. I'm giving you 5 marks. Thank you. That's a very lovely answer, please. Debit POL and credit bank. Thank you. So what will be the capitalized cost?
Okay. Final coding approximation.
2
So we have what? Final coding. How much is it?
1.5 million. 1.5.
What else again?
Salaries of staff of developers directly involved.
How much?
600,000.
600,000.
Is there any other one again?
No.
So this will be the capitalized cost.
2.1.
2.1 million. So what would you do to this one?
We are going to debit the asset account and credit the bank.
Thank you. I think that man open our eyes.
I don't get that.
Thank you. So that's the A part, I guess. The B part, they said the condition that must be met for the capitalizable cost to be recognized as an intangible asset. Who can tell me the acronym first?
Capital.
What was the acronym?
Carpenter.
Freak.
So you went and checked your book before you can tell me.
No, sir. I just joined now. My network is having issue, so I'm not kind.
Okay.
It's so the part
So
I
what-
joined is well capitalized.
Okay. So what is the condition that must be met for capitalization of cost to be recognized as an intangible asset? Just give me the acronym.
Freak.
This question you are saying as it is now that you are joking with it now. This is a 7-mark question. No. If you have 7 now, how many are you looking for to pass? 43. Eh? That's why you don't need to miss class. You understand it now? Conditions is freak. Just write freak for them in exam and come out. Don't tell them it's me that asked you to write it. So.
Sir, please can you please help us scroll up a little on that question? Yeah.
Are you okay?
Yes, I'm fine. Thank you, sir.
All right. So let's go to illustration 2. Required. Explain the treatment and pass the journal entries. So let's read. Ifrs Tech Limited wants to launch a new accounting software. During the year 2025, the company incurred the following costs. After management confirmed the project was viable, the company spent. Ifrs Tech also purchased. The software became ready for use on 1st January 2026. Useful life is 5 years. At the end of 2026, recoverable value of the software dropped to 2.4. In 2027, Ifrs Tech sold the license for 500,000. Require. Explain the treatment and pass the journal entries. Now with this, you should know that they have even helped you to classify it into research and development, and also. So you may choose to ignore, but since they said determine the accounting treatment, just go ahead and let's give solution to each year. Solution. Expendable cost. So from this question, what Are the costs will be expensed?
Market survey to know customers' need.
Please snap the question so it will be easier for us to navigate. Have you snapped? You have snapped now?
Yes, I will snap.
Okay, yeah, let's go. So solution expendable cost. Number one is what?
Market survey to know customers' needs.
How much?
300,000.
300.
300,000.
300, sir.
Next one.
Feasibility study by consultants.
Is this will be expensed?
Yes, sir.
How much?
No, sir.
capitalize.
200,000.
So you capitalize it, though.
Why? Expense.
Please, visibility
But
cost.
expensive,
Visibility
200K.
is like market survey. Visibility is like market survey. You have to expense it, please. I'm begging you people. Oh, yeah, how much?
200.
200, right?
Yes.
What is the third one?
Initial programming trials.
Is it to be expensed?
Yes, sir.
Yes.
Do we
Yes,
all
sir.
agree?
Yes, sir.
How much?
400,000.
400,000.
Is there any other one again? Any other one to be expensed?
Yes.
Which one?
Final testing before launch.
No, that is capitalized. Final test.
Okay, yes, it should be capitalized.
There's no one again.
There is no another one again.
Total? How much is the total now?
900.
So what do you do with this one?
You debit POL and credit bank.
Thank you. So the other one is the capitalized cost. That is what we call the initial
So,
cost.
of the final testing before launch.
I explained it earlier. Final testing before you launch is a cost that you should capitalize. Take for example now, what is it called now? You made let's use what is common. Let's say as long as you produce yogurt. You have the idea. Let's even use the production life of yogurt now to explain this thing. You want to produce the yogurt. That's your idea. You are thinking it in your head. That's your idea. You now move around to ask your neighbors, your friends, when I go drink yogurt, will you people drink yogurt? You transport yourself there, you check through, you do all manner of things, you even market. I want to start doing yogurt to you people buy. That's what we call a market survey. You understand now? You now move ahead and say, okay, since I've moved around now, you check. Okay, now people in this also location, they are going to buy. 50 will buy, this one will buy, that one will buy. That's what we call visibility study. You have done your study. You now kept your book. You wrote a report on it. You kept it. You did not act on it. All of those costs will be referred to as your research costs, and they must be expensed in your profit or loss for that particular period. But now you now decide to say, okay, I want to produce the yogurt. You want to produce it as it were. You bought all the machine required, everything you need to know. You know that all of those machine, they are referred to as tangible assets. Is that not so? So they will be treated according to IS 16 under PPE. But now you have to test. You have done the product. Now you have produced your first yogurt. You want to be sure If it's something that somebody can take, you understand how heady it is, you need a feedback. That's what we call, before you now launch to the market, that's what we call final testing before you launch. You gave it to this other person. So that's why I said if we're in the class, I mentioned something like quality control testing or performance testing. You understand? In the production line, that's what we call it, performance or quality control. To be sure that this product can actually gain market preference, can actually gain market attention, can actually be embraced by the market. So that's what we call final testing before you launch. That cost of final testing before you launch should be capitalized. Do you understand? As part of the cost of the product. Do you understand it now? Are we sitting together? Is it clear now?
Yes, sir.
So
Yes,
that
sir.
means of historical cost or initial cost. So what are the initial costs of this particular intangible asset? The initial cost will always be the cost that you will capitalize as something that you are going to recognize the asset with initially. So give me, do we have it in that question? I'm sure we do. What are the costs, please? Let's go, let's go, let's go.
Final software coding.
How much, please?
Yeah.
Oh, yeah.
1.5 million.
Okay. What's the other one?
Salaries of developers.
Salaries of a developer. How much?
700.
Is there any other cost again?
Final testing before launch.
Final testing before launch. How much?
300.
300,000.
Is there another one again? How much is this?
Yes, it's license. I will not call that one.
Okay, license.
From another company.
This license is what? Is it an internet generated or externally generated?
Externally generated.
So you have to capitalize.
Externally generated.
Thank you. So what's the total?
3,100.
3,100,000.
300. So that's the total. So this is what we call the initial measurements. So we now go and determine the subsequent measurement. So we have 20. What's the year? (2026). You have initial cost. How much? 3,001. Any depreciation amortization? I told you that subsequent measurement, how many models are we going to use?
2.
So which one are we using now?
One. Use
Cost
cost
model. Fair value model.
Cost model.
Fair value model.
Thank you. So, but I've always advised, always use your cost model. Based on this information that is even giving model, we are going to use a cost model. So amortization now we have to do our workings. How many useful life do we have?
5 years.
5 years.
5 years.
So what will be the amortization cost? Oh yeah.
620, sir.
612. Thank you. So what will be the current amount for that year?
2480.
Is there any impairment? I've always told you, always check.
Yes, there is.
So when we minus 600 from 3 man, what do we have?
2,480.
You say there is impairment, so let's look at it.
At the end of 2026, recoverable value of the software dropped to 2,400. 2,400,000.
So meaning that you know that the current amount at the end was 2,480. So there is an impairment here. That is, we just did impairment. Who can tell me the meaning of impairment now? Or how do you determine it?
Just like reduction in value of assets.
Impairment is a reduction in the
Is
value
when
of
the carrying amount.
okay, when the current amount of an asset is higher than the recoverable value, right?
Yes, sir.
So from this particular question, now you see they are interwoven. That's why you need to know them. You can see that the current amount is higher than the recoverable value. So what is the impairment?
80.
80.
So what will now be our current amount?
2,400,000.
Current amount. How do we see the impairment?
We debit P&L and credit the assets.
Thank you so much. Let me clap for her. I'm giving you 1 mark. Thank you so much. That's very, very good of you. All my students, they are hot. Oh, you people are on fire. I can't is in trouble. You will deal with them.
Please.
Amen.
Amen.
I'm sure you will deal with them. With what I'm saying, I mean, I'm very certain. So that is the current amount. What did they ask us to do again?
Can you please come again on the treatment?
Oh yeah, auntie that spoke on the treatment. Go ahead.
We debit P or L and credit the assets.
Thank you so much. Very correct. Debit POL with the impairment and credit the asset. And what do you, when you do that, you will be reducing the value of the assets to what is prevalent in the market. That is the amount at which you can recover the asset. In other words, you are not overcarrying or overstating your asset in your books. So that is that for that. This is how to do the calculation based on what is here. So we have the same 2027 Fartech sold the license for 500,000. So we need to get the if there will be gain or loss on this. So license, and it says spell license you. N there. License. License sales. Valuation. So what is the current amount of the asset? Current amount. That will be equals to, what's the historical cost of the asset? 600, right? 600 minus the depreciation. Oh yeah, give me. Hello.
80.
120. 120.
Okay, let's do it one after the other.
Okay, let's do it one after the other.
So that
480.
cost is 600. Then amortization. Because this one that I did direct now, somebody will ask me a question here today. 600 divided by 5. What's the depreciation?
120.
120.
120.
120.
So the current amount will be 480.
480.
How much was it sold for?
500.
Sales value. Determination of gain or loss on disposal. So you have sales value 500 current amount. How much is the current amount? 480.
480.
So there's a gain of how much?
20.
20.
This gain on disposal, how will you treat it? Oh yeah. How do you treat your gain on disposal?
We are going to credit the P&L and debit the bank.
You're going to credit
The P&L.
We are going to post it and debit it to OCI under POL, and then credit it to the assets.
Okay, anyone want to try again?
Debit the asset and credit. Debit the asset and
We'll
credit.
credit POL
You
and
debit the
debit the
OCI.
assets to
Debit the assets
signify
to
the increase in value of
signify
the
the
asset.
increase in value of the asset.
Yes. So you will debit OCI and
We debit
credit
our
the
debit
asset.
our own.
Have you seen it? I can't hear you. You said?
Gain on results. Can you hear me, sir?
I can hear you. I can't hear you, brother.
I said gain on disposal.
Yes.
How money is it meant to go to OCI?
You will
Please,
not
Mr.
take it.
Anam, please off your mic. You can't hear
You
a
will not.
question.
Okay. You will not take it to OCI. Why? Because it may be non-monetary, but it's adding value to your business. It's generating what we call future economic benefit to you. As it's either it is increasing your revenue or saving you some cost or helping your operational efficiency. You understand me now? The only thing you can take to OCI is when you have revaluation gain. That one is fictitious. Fictitious. It is not real. You understand? So that's you take it there. Or when you have a gain on any foreign exchange transaction, you take them to your OCI because they are also fictitious. They are not real. They have been created artificially. You understand? That's why you take them to your OCI as other comprehensive income. I'm sure it is clear.
Hello, sir.
Yeah, that is generally known. Disposal is not meant to go to OCI.
You have to go and credit your P&L with the value. After all, when you sell now. You're not going to get the cash. The license that you are selling, they will not pay you money. So you will throw the money to where? But if you do the valuation now, are you going to get money? Will they pay you anything? No. Are we clear now?
Yes, sir. Please,
Hello,
can you go up a bit?
hello, sir.
Yes, please go ahead.
Go up, sir.
Hello, sir. Please, I want to ask a question, sir.
Go ahead,
Hello.
please. Go ahead.
Please, what I just want to ask is that, please, I don't understand the journal entries and all this accounting treatment, sir. How can you help me to explain the journal entries and the accounting treatment?
The belief of ICANN is that you have passed through foundation class, and by now I should not be doing journal entries for you now. Okay, but what we have done now, there is nothing much there now. These are just like walk-ins, and I'm telling you how to do all the treatment have been stated here. So if I need to understand what you remember, because this treatment now is not a journal entry. Debit intangible asset and credit to P&L is not a journal entry. It is now. Or you want me to be drawing T? Bros. What we do is after this class, DM me. I will teach you especially on that. Okay?
Okay, thank you.
So we are done with intangible asset. I'm sure you are
Hello,
clear.
sir.
Yes, go ahead.
I thought the gain that we have in the development of our assets, won't we debit the bank also? Because as far as cash come into our organization.
Look at it this way. You can, there are two ways to it. Number one, this particular asset that you are selling is already in your assets. That also is already in the class of your asset. Look at it here. Where is it now? This is our initial cost. Did you see it here? This place that we got 3,100. Is that also? Since it's in this 3,100, you now sell the license. You have to debit this away. Debit it away from this group of what makes us an intangible asset. You have to debit it. So you have to nil it off from here. You understand me now? And then you now create what is it called? Your income. And as long as it's your income there, you can as well go ahead. If you receive cash, you debit cash. If you receive it to a bank in time of transfer, you debit and transfer. In other words, it will be increasing your transfer.
Bank.
Your bank. What is it called? Bank, yes. You understand it now? So, but the first entry must be that you are debiting the assets to reduce the value of the asset, to reduce that amount, to remove that amount from the total value of the asset. And then you credit your profit or loss account. That's the income now. It will be an additional income to you. That is other income. This one now, we classify this again on disposal under the other income category, not under revenue. You put it under other income. You understand it now? Is it clear? Somebody is asking, where do we get this note? When you pay for the note will be made available now. For those that are paid, they've been seeing the note and enjoying it. And all of these updates are on the notes. After this class, we'll put it there again, where you can pay and get the note. So please, within a little time that we have, let's go to the next. Any other question? I'm sure we are clear. Intangible assets is not something that should be giving you headache. It's not it. It's very cheap, very simple. Everything about it is what we have discussed. Any question? I'm sure no question. So let's go ahead.
So please, there's question. Sorry.
Ask us.
I just want to confirm something. This capita that you mentioned, is it the criteria that needs to be met when you want to capitalize intangible assets that are generated internally?
Yes, at the development stage.
Okay.
Yes.
Why the other one freak is both internal and external?
Well, for you to recognize intangible asset in your financial statement, whether internally generated or externally generated, they must meet that 4 criteria.
Okay. Thank you.
You're welcome. No other question? So let's look at this IFRS 5. Non-current asset held for sale and discontinued operations. Overview. That is, what is IFRS 5 all about? Look at the headline. It says non-current asset held for sale and discontinued operation. Summarily, as a layman to a layman, this simply means that you have an item under your non-current assets. Now you don't want to use it again, you want to sell it. That's what we call non-current asset is held for sale. And discontinued operation means that you have maybe a branch or a division or a product line that you don't want to use again, you don't want to continue with again, you discontinue the operation. So this standard is what cover how to account for it in your book. Don't let your head burst. To just relax. It's also a very simple standard. So once a company decides to sell a non-current asset or a group of assets, instead of continuing with the use of them, IFRS 5 give us what exactly we should do, how we should treat those assets. So the standard explains when an asset should be classified as held for sale, how it should be measured, how it should appear in the financial statement, and how discontinued operations are to be reported. So IFRS 5 apply mainly to when management have decided, management have decided to sell off, that is, either to sell off the assets or discontinue the use of the assets, and not that they are still using it. So if management decide that, okay, this motor vehicle, we sell it, but they are still using it in their operation, you cannot classify that asset as held for sale. Or for instance, if management have decided that, okay, this branch in Ikeja, we are going to discontinue the operation by next month, and they are still using it to trade in the business, it means you cannot in any way classify it as a discontinued operation. So for it to be held for sale or for it to be discontinued, there must be this absolutely management commitment to sell and not to continue to use the asset or the operation line as it were. So what are non-current assets held for sale? They are A non-current asset is classified asset for sale when the carrying amount will be recovered mainly through sale and not through continuous usage. When you believe that the asset will no longer add value to you, and then you believe that for you to recover any amount on it, it will be through sale and not the use of the asset. In other words, entity have believed that the future economic benefit of the asset will be recovered through sale and not continuous use. Then we have what we call disposal group. In other words, as non-current asset held for sale can be a single asset or asset that is within a group, a close users group. So if you have assets that are close together, in other words, you cannot sell them in piecemeal, you cannot dismantle them to sell, they must be sold together. Then you know, this idea of sale must be top-notch. That is to say, management must be committed to selling the asset and not to continue to use the asset. So what I'm trying to explain here is that we may have single asset, that is a standalone asset that is being held for sale, and we may have disposal group that is being held for sale. Either way, there is the intention and commitment to sell and not to use any of the product. Example, like I gave you, factory, equipment, and inventory are sold as one package instead of selling factory separately, equipment separately, inventory separately. Take for instance, if you want to buy a car, you will not buy steering separately, you will not buy the seat separately, you will not buy the boot separately, you will not buy the tire separately, you buy them as one. That's what we call a disposal group, a type of a disposal group. Take for instance now, when they want to sell one of the shop right, I won't mention the location in Nigeria, they did not in any way say, okay, we are selling one of the sections to this social person, we are selling this section to this social person. They sell the whole of the shop right together, both the asset and then the inventory. So that is what we call a disposal group. Then discontinued operation, like I've explained, is when you are disposing of certain operations or your major line or a branch in a location. You are discontinuing the operation fully, and that will reduce sales. Okay, go ahead, please.
Sir, can we also call that a cash generating unit?
I'm just giving that as a layman example so that you understand. It's not a cash generating unit.
All right. You mentioned of shop right. That's why.
Yes, I'm just telling you. Is a cash generating unit that is in a way. You understand? Because they belong. I don't want us to use it here so it won't confuse you. You understand me now? Let cash generating unit be for statistics disposal group. Let it be for IFRS 5.
All right. Thank you, sir.
All right.
I have a question.
Okay, go ahead.
Okay, so you said IFRS 5 is when the company needs to sell the goods and no one when they are using it. So my question is, there was a thing that one person wanted to sell. So for the fact that he has not seen a buyer, so he continues to use the asset, and immediately the buyer comes, he disposes it of. So can we categorize that also as non-current asset?
Okay, now to answer this your question, let's go to the next subtopic here. Conditions for classification as held for sale. This will help you to resolve your curiosity. Conditions for classification as held for sale. For you to classify any asset, whether standalone or disposal group asset, these criteria, all of the 6 criteria, must be fully met. They must be fully met. And I wrote something, I say, very important for ICANN students to note this. This is where, if they are going to ask question on IFRS 5, this one must come before you do calculation. This one must come. Number 1, the asset must be available for immediate sale. That is to say, you are not going to use it again. That's why I keep mentioning the word sale, not use. So asset is available for immediate sale. Asset is what? Available for immediate sale. So before we go ahead, I think I have an acronym for this. I call it MASA. MASA. The M stands for management is committed. A stands for asset is available for sale. S stands for sale is highly probable. The other S stands for sale is must be done within 12 months, and the other A stand for asset are marketed at reasonable price. So MASA, don't forget MASA. What are the criteria for classifying, or the condition for you to classify an asset for sale? Just write MASA. For those that are from the north, and my students that are from the north, I'm sure you will not forget this one. Those that are eating MASA, don't forget MASA, MASA, MASA. MASA is the condition for classifying an asset for sale. The M stand for management is committed to sell. That is, they have already made up their mind, they are selling, they are not using that asset again. Management is committed to sell. The other A is asset is available for immediate sale. It is available now. If there must be a buyer, a buyer to buy, and then it is in the market for sale. Active program to locate buyer, that is, you must be all out to make sure that is the buyer. Then sale is highly probable, that is, the probability that you will sell it was more than 50%. Then the sale is ready to be within 1 year. If the sale will not be done within 1 year, it will not be classified as asset for sale. Then the market must be at a reasonable price. Asset is marketed at a reasonable price. You don't put a unnecessary unreasonable price on it and you call it a head for sale, because if you put an unreasonable price, the asset may not be sold within 12 months. So you don't put an unreasonable price on it. So these are the 6 criteria, as it were, that must be fully met. So we have MASA. I hope it's even correct now. I hope we have 2 A's here, 3 A's rather. So we have MASA. So you don't put it that way. MASA. All right, can we go ahead? Is it clear enough? All right, so those are the conditions that must be fully met. And the recognition is that once all of these items, all of these conditions are fully met, you classify these MASA condition must be met. So what? Recognize head for sale in the statement of let's just say in the financial statement. In the financial statement. So it's as simple as that. Please take note of that. So all of those conditions must be met. And once that condition is met, the first place to classify that asset is under your current asset. In other words, the first classification is for any head of sale, any head for sale asset is under your current asset. So the non-current asset now will now move from non-current asset to current asset once these conditions are fully met. So what I mean is this: you have a PPE now. Let's use a motor vehicle that you want to sell. So all of the 6 criteria are met. Management are committed to sell it. They have decided to sell it within 12 calendar months. It is available. There are available buyer. The market price are reasonable and the likes. Every one of the conditions are fully met. Once that condition is met, you classify the asset. That motor vehicle, you classify it asset for sale. Now, you will no longer recognize it under your non-current asset. You will now take it to your current asset. Why? Because the sale must be done within 1 year, within 12 calendar months. And when the sale is done, you recognize it as your other income. That is, your other income under your profit or loss account. In other words, you will now credit the asset in your current asset. You will now debit, what is it called now? Credit the asset and debit your income asset. Credit your income and debit the asset. Debit bank, sorry. I want to ask a question. This raising of hand is also what is making us to enjoy the class. So go ahead, ask a question.
All right, so thank you very much, sir. So I just want to ask about the reclassification. I remember that one of the conditions is that the assets must be ready for market sale is expected within 12 months. I want to know if this affects that condition in such a way that, let's say, our reporting period is within the next 3 months, and can we reclassify the assets since there is no space of 12 months before that? So let's say in 3 months' time, we discover that we need to sell these assets for sale. Can we reclassify it and then report it during our reporting period in 3 months? Are we allowed to do that?
Yes, you are allowed to do that.
I'm not ready.
You are allowed to do that if, for instance, you know, in practice, there are so many things that are, you know, incoherent. Let me use that word. There are so many things that you see in practice that, you know, you just have to use your skepticism to decide, you know, the matter, as it were. What I meant is this. If, let's say, there is 3 months at the end of a calendar year, management decides to sell the asset. Remember, you only have 3 months left in the calendar years, in the current calendar year. For you to classify the asset as held for sale, it is either you are too sure that within that 3 months you are going to sell it. But if you are not certain or sure that you will sell it within that 3 months, you are allowed to report it and classify it for the, you know, the next financial year. Classify it in the next financial year as your head for sale. But you have to report it, disclose it. You understand me now? Is it clear enough?
Yes, I do. Thank you. Yes, sir. Thank you.
Right. Measurement. Go ahead.
Because,
Huh?
you see something about this application. I think what I mentioned was credit income to debt. So I spoke about
You said what? I said once, yes, once you sell the assets, you are going to debit bank and then you credit what is it called? Your income, other income.
Yeah.
That's your profit
Yeah,
or
yeah.
loss. P or L. Not, don't call it P and L. If you call it P and L again, I will can you P or L, profit or loss.
the part where you said non-current assets classified as current assets, then are still subject to
Okay, so this is how it is going to be done. Once. All right, go ahead, Maureen.
Okay, sorry. My question is on the massa. So, during exam, if will I be penalized if I use mass as in mass instead of massa, which is management commitment, active plan to locate buyers, asset available for immediate sales at present condition, sales of asset expected to take place, and then sale of asset on high probable.
Well, if that is not to remember, please
Okay,
write it
sir.
for them.
Thank you, sir.
But my advice would be these 6 conditions must be met before you can recognize any asset for sale.
Thank you, sir.
So going back to the question that my sister asked me, now let me go back and explain. Once you commit yourself as management to say you want to sell a non-current asset, and all these 6 conditions of massa are fully met, you are going to reclassify that asset. That is to say, you change the status of the asset from non-current asset. They can no longer be called non-current assets. Now they will be reclassified and brought down to what is it called? Current assets. In other words, the first thing to do is you are going to now credit your PPE and debit your current assets. You understand me now? That is, you are changing the status of the non-current asset. Why? Because you know that anything that is under the current asset, they are to be used as a working capital within 12 calendar months. So if you know too well, that's why we say management must be committed. Management not only will be committed, they must look for buyer. Not only will they look for buyer, they must be sure that they are going to sell the asset within 12 calendar months. You understand me now? That's why master condition must be fully met. Fully met. And once it's met, you reclassify the asset from non-current to current asset because the sale is highly probable to take place within 12 calendar months. And I went further to say that once the sale is consummated, what you just do is for you to debit your bank or cash and then credit your P or other income. Simple. Is it clear now? I'm sure it is clear. The measurement.
Sorry, sir, please repeat that. This thing said now that we should debit. Is it debit non-current asset and credit current asset? Sorry.
Debit bank.
No, not when you recognize income. The first stage where you remove it from non-current to current asset.
Okay. The first stage is for you to debit the current asset and credit the non-current asset. When you credit an asset, you are reducing the value of the asset. When you debit it, you are increasing the value of the asset. Okay?
So, but you said PPP, that we should debit PPP, then credit current asset.
When did I say so, Auntie? Listen now. When the master condition have been fully met, you are going to debit the current assets and credit the non-current asset to change the status, bringing the asset from non-current to the current asset. Remember what I said. When you are debiting an asset, you are increasing the value. When you are crediting it, you are reducing the value. Now look at it this way. You have an element of PPE. Let's take an illustration. It's like the thing is confusing all with this. Let's say PPE is PPE currently that we have. Total is 400,000. Management now decided, okay, we want to sell part of this PPE for 100,000. They have already decided. The master conditions have been fully met. You understand now? For you to remove that 100,000 from this particular PPE, the accounting treatment is you are going to, because you have to remove that 100. Now, the sale is not taking place immediately. It's going to take place within 12 calendar months. And because of that, you need to now bring the asset. That's why in your questions, some of your questions, you will see where they will put non-current asset held for sale. You will see it there under your current asset, non-current asset held for sale. So that kind of asset has already changed status. That is, it must be sold within 12 calendar months. So what you do is you debit your current asset and then you credit PPE with that 100,000. So when you do this, the 400,000 will reduce to 300. And then you now have a new value in your current asset as 100,000. So the next thing to do is if you sell the asset, you will not debit your bank or cash and credit your P or L or that income. Simple as ABC. Clear enough? Can we go ahead? I'm sure we can. Measurement. Once you have classified asset for sale, the asset is measured at the lower of the carrying amount and fair value less cost to sell. That is to say, how do you, and I've told you before, measurement means how do you calculate the value? So it will always be at the lower of anyone that is lower between the carrying amount and the fair value less cost to sell. Let's assume, for instance, now that the carrying amount of a PPE carrying amount is 500, and then the fair value less cost to sell is 400. Which one will be the cost to attach to the head for sale?
The fair value less cost to sell.
Yes. Why? Because there is the one that is less. You understand now? Why do we do this? And so that we will know that buyer will actually buy the product. You understand me now? If the fair value less cost to say is 400, it simply means that in the market, this product that you are holding for 500 is sold for 400. You understand me now? Now let's assume the other way around. Let's assume the other way around. Let's assume this is 400 and this is 500. That is fair value less cost to say is now 500. What will be our carrying value? What will be the value to be measured? What will be the value that will measure the head for say?
It should be the carrying amount.
Yes,
It will be
the carrying
the,
amount.
it will be the carrying amount. So if the carrying amount is 400 and the fair value less cost is 500, it means that even in the market, the value that we have currently in our book is 400, though, but in the market they are selling for 500. So there will be buyer to quickly and easily buy the item. Simple as ABC. Now let's go back to the initial example. Let's assume this is 500 and this one is 400. You know that your fair value less cost to say is the recoverable value, and your carrying amount remains your carrying amount. The carrying amount is 500. Fair value less cost to say is 400. Is there any impairment in this particular scenario?
Yes, there
Yes,
is.
100 naira.
There is an
100
impairment of 100 naira. So whenever the carrying amount is higher than the fair value less cost to say, there will always be impairment, and you must recognize that impairment. What is the journal entry? Just debit impairment to your P&L, and then you credit the asset for sale. That's the first entry you will do first before you go ahead and do the second entry of once you have sold the item, before you do the second leg of it. Let me come again. When the current amount is higher than the first fair value less cost to say, there will always be impairments. And once there is impairment, the journal entry is as simple as ABC. Just go and debit your P&L with impairment and then credit the asset held for sale before you sell the asset. So it will now reduce the value of the asset to 400 in your book. And when you now sell, you go back and credit what is it called? Debit your bank and cash and credit your P&L other income. Simple as ABC. Now,
Sorry, sir. Please, can you come again? I'm sorry.
okay. Whenever the carrying amount of an asset is higher than the fair value less cost to say, in other words, what your book value is saying is higher than what the market value is saying, there will always be an impairment. And whenever there is an impairment, you must first of all recognize it in your book. In other words, you must reduce the value of the asset that you are carrying asset for sale to the to the fair value less cost. So that is the market value. Why? Because we said that in measuring the cost of head for sale, it will always be the lower of carrying amount less cost to say. Carrying amount and fair value less cost to say. That is the lower of the two will be your cost that you will attach to the asset that is set for. The meaning is that, for instance, you have decided to sell a motor vehicle. The motor vehicle have 400,000 naira as the carrying amount. At the time you are making the decision, you now discover in the market that the fair value, that is the market value of the car, is now 300. It means you are overstating your the value of that asset in your book already. So it implies that there will be what we call an impairment. If you are in the impairment class, the statistics class, you will understand this better. But if you have not, please watch that video so that you understand it. So when the carried amount of the asset is higher than the fair value less cost to say, the fair value less cost to say is another type of recoverable value. Once the current amount is higher than the fair value less cost to say, which is also known as a recoverable value, it simply means that there will be an impairment. And once there is an impairment, you must always recognize it in your book. That is the first accounting entry you must make on any of head for sale, as it were. That's the first entry. That's the first entry. In other words, you must carry the present value of the item in your book. How do you do it? you just go ahead and then you credit the asset held for sale and debit the POL. In other words, you recognize the impairment as an expense in your book. Is it clear enough? I'm sure it is clear enough.
Yes,
Can
sir.
I go ahead? Yes, I can go ahead. So now, there's one thing I want to state here clearly now. Depreciation. Once an asset is classified as asset of sale, you cannot depreciate it again. Depreciation must never be found in that book. Because the sale is going to come, the sale will become what? A recoverable value to the entity. Company will recover value through sale. So depreciation do not apply. Is that clear enough? Please take note. They may write it for you, but once the asset is now classified as held for sale, they may put it in your question. Please note it. Once they say this asset, we are classifying it for held for sale on 30th June 2020. Just know that from 1st of July 2020, you cannot depreciate that asset again. In other words, depreciation stops at 30th of June 2020. Is that clear enough? I'm sure it is clear. Any question? No question. Why is that? It's only that I'm answering myself now. So now discontinued operation. Once you have what we call discontinued operation in your book, or that you value any discontinued operation, this is how to treat it. Go ahead. So let's go ahead, man. Once there's discontinued operation simply means you are no longer going to continue the operation of maybe a branch or a division or a product line. When that happens, you will recognize it as a profit from discontinued operation after your profit after tax. Once you have been able to identify your discontinued operation, that is, you measured it, you get the value. Because discontinued operation, the process is the same thing as when an asset is being held for sale. You have already decided that this operation, like the master criteria must also apply for you to discontinue any operation. Master approach must apply. But once that master approach apply, then you go ahead, please. Go ahead.
Sorry, sir, I couldn't unmute myself before. I need to ask a question under that depreciation, please.
Depreciation. Once an asset.
Yes, I want to ask a question on it.
Go ahead, please.
Like the car, this thing. Let's assume that maybe a company, after getting the car, and they intend depreciating the car for 5 years. Assuming that it is the usage is for 5 years. So the reason that after the 5th year, after it has been depreciated, then the car will have to be transferred to items
held for
sale immediately.
No, you see, that's why once if you check now, when you are depreciating an asset, it is either you have a residual value or you have zero value. But when it comes to regulation, for instance, now, we do not allow your assets to be at zero. Why? Because there is no way you can tell me that after you are fully after you are fully depreciate your asset, you are just going to dispose it. Some of these assets will still remain within use. And once they continue to be used in your ordinary course of business, the value must still be there in your book. That's why we always advise that there should be a residual value, or there should be at least 1 naira or 10 naira, depending on what you want, 10 naira to 20 naira on the book when it has been fully depreciated. Not all assets, when they are fully depreciated, it is not that when an asset is fully depreciated, you now say you want to head it for sale. No. It's not always so. Held for sale Can be that you buy the asset today and tomorrow you decide that you are selling it. You understand now? So even if an asset is fully depreciated, you can still continue to use it in your book. But once you decide that this asset, though, I'm going to sell it, you are going to ready for sale, then it means that whatever value that is remaining on that asset in your PPE, you have to, transfer the value to the current asset of your senior financial position as a held for sale, because you are going to sell it having met all of the MASA criteria. So not all assets that are fully depreciated are classified as held for sale. And not because an asset is fully depreciated, you now classify it as held for sale. As long as you still continue to use them in your operation, you cannot classify them as a held for sale. So the MASA criteria must actually be in full force. You must comply with it fully before you can classify it as a held for sale. Is it clear enough?
Very clear, sir. Thank you.
All right. So now, discontinued operation. This is how it is. I'm giving you a C sample below. This is the sample. Once you have done the calculation on your discontinued operation, that's the way I've explained it. This is how to put it there. Look at it here. Profit before tax. This is what we call continued operations. 5. Tax expense, 1.5. Profit after tax, 3.5. Then you will now recognize profit or loss from discontinued operation. Net of tax, 800. Tax profit for the year, total profit for the year rather, will now be addition of continued operation and discontinued operation. This is how to recognize it in the books, in your financial statements. That is for discontinued operation. Is it clear enough? Can I go ahead? I'm sure I can go ahead. Disclosure. Always disclose the type of asset that you are disposing. Very, very important. Whether it is a standalone asset or a disposal group, you must always tell us. You must tell us the circumstances and the fact that surround the sale of the asset. Is it that the asset is no longer giving you economic value? Or is it that management need money? Or is it that the branch or operation that you are going to discontinue, need to be discontinued for restructuring sake? Any gain or losses that is recognized, you must disclose it. Then you must tell us the segment or the division or the branch or the location that is involved. You must state it in your disclosure note. So those are the main things that you need to know under IFRS 5. It's a very, very simple standard. But if you don't know it, you don't know it. But thank God that you know it now. Any question before we take illustration? Okay. Can you still hear me, please? Okay. Let's look at this illustration together. Prime Tech PLC owns 5 machines used in production. On 1st May 2025, management announced plans to dispose some of the machine as part of a restructuring. Additional information: machine P and Q were approved for immediate sale by the board and actively marketed at reasonable prices. Machine R has no buyer yet, and management intends to refurbish it before selling it next year. Machine S is still being used in production, and management have not committed to sell it. Machine T has a buyer, but regulatory approval is still uncertain. Details are 1st of January 2025. Asset PQRST, you have 1 million. The annual depreciation, they are also there. The fair value less cost to sale is this, and the tax rate is 30%. Required: identify which asset qualifies as held for sale under IFRS 5, given reasons. B, calculate the carrying amount at classification date. C, compute impairment losses, if any. D, prepare journal entries. And E, explain depreciation treatments. Can we all attempt this?
Let's do it together, sir.
Do it together again. So which one will you now do on your own? Don't worry, I will serve you meal. I've been serving you people meal, and there's only a few persons that have been responding to that meal. Are you even not eating the breakfast?
Show the question so I can snap.
Okay, that's true, Jerry. Thank you. Okay.
So please, is fair value the same thing as probable amount? I'm able to answer the question.
Yeah.
Like fair value, if you take fair value, doesn't mean the amount they are selling the goods, like is it like a recoverable amount, or how can we classify fair value? Like fair value in general, the money they sell on the good or the money they're about to sell the asset.
See, fair value simply means, if you are to sell the asset now, you know that you are not going to sell it, but you just want to know if I'm to sell this asset now, how much can I get from selling it? So there are criteria. Number one is that there must be what we call active participant. There must be what we call an active market. In other words, the active market means you can easily enter there, you see what they are doing there. You don't need to say you want to sell, but you know that, okay, this is what you want to, these are the amount they are selling it. Take, for instance, now, you have a generator. If you go to Alaba market now, you don't need to be asking them, just know the type of your generator and go and how much is this one? Oh, this one say 20 naira. How much that one say 20 naira? Then you should know that that's your fair value. That's the market price of the generator. Do you understand me now? I think the next class we will look at Ifrs 13 fair value measurement. I wanted to skip it before because we have already been saying something about it, but let's just look at it together so we have an understanding of it. Do you understand now? So fair value is like a recoverable value. If you are to sell it now, this is the amount that you are going to recover in the market. You understand? And I told you there are two types of value that you can use. You can use the value in use or the fair value. If you are to continue to sell, if you are to continue to use the asset, what will be the future cash flow? You discount it into today's value. So recoverable value can either be fair value, let's also say, or value in use. You understand? But for this head for say IFRS 5, you can only use fair value less cost to say. Why? Because from the criteria, the management was committed to sell and not to use the asset again. So that commitment to sell has already, make only the recovery value for head for say to be fair value less cost to say. I mean, recovery value will now be a value at fair value less cost to say. Is your question answered? All right, thank you. So let's go. Solution.
Sir, the question, please.
Go ahead.
No, the question. This particular question. You want to snap it?
But I put it down before it is not now. Can I shift it?
Yes.
Yes.
Okay, can you go ahead now? Solution. So, okay, putting solution before. Hey, now. So, which of the assets is each of these assets qualifies head for say? Let's go back. Martin P.
P and Q.
Approve for immediate. Oh, yeah, give me reasons. So if you ask, give me reasons.
Because immediate use of that asset will stop, and management they've agreed to sell it, and also the price is reasonable, and they're actively marketing the product.
Thank you. So it has met the massa conditions. So P and Q can go, and it has met because it has met the massa condition. So you state the massa condition. It's as simple as that. So as it stands now, So matching what's wrong with this one? So matching what matching P and Q, right? Or is it matching P or
Yes, P and Q.
PIQ.
matching P and Q can be classified as a head for sale because one management approve immediate sale. Two, two active marketing.
Markets.
Three, give me the massa.
They say it's highly probable.
How do you know?
Because the price is reasonable, so buy out.
Five, price is reasonable. So please how to answer. B, what did they say we should do in B now? Calculate the current amount of at classification date. That one is something that we're able to do it. Oh yeah, what are the current amount at classification date? Give me figure. Did they say current amount of the current amount? Okay. Here is P and Q now. So what is the current amount?
920 and 760.
How did you get it? Oh yeah. Give me P. P is one.
From the fair value less, because the fair value less cost of sale is lower than the other one.
Small value of Jesus Christ. 920.
What is the Q on?
800 minus 80.
What will it be? 720, I guess.
720.
Yes. So that's the carrying amount of the goods. So I think we are done with B. C, compute impairment losses. So that means we have to compare C determination. Where?
Sorry, sir. I thought you said once the asset is classified as F for sale, they will not depreciate it again.
Let's read the question.
Can you mute? Mute Nnamdi.
Thank you for asking that question. So they said on 1st May 2025, management announced plan to dispose the assets. These are the details as affect the general information.
Nnamdi, mute. Nnamdi, mute.
Nnamdi should mute his mic now.
Okay. So now from here, we can see that that question is actually valid. We have annual depreciation of 100. So it means that this 100 now will now be multiplied as our depreciation will now be. I was wondering why is this question so cheap now. I didn't know that they put one logic there. So the same management management announced plans to dispose some of the machine on the 1st of May 2025. Meaning we have January, February, March, April to be the depreciation. All the asset will be depreciated up until the 30th of April 2025. Is it clear enough? Always look at the question. Oh, I'm begging you. Thank God that that lady they actually brought us back now. We know I will not have seen it. Oh. Yeah? Multiply by how many months is that? 4 minus 12. That's 8. 5 by 12. Is it now? Yes. 4 over 12 rather, not. So what is the depreciation? Oh yeah.
33.3.
So minus it from 100, what will it give to you? Minus from 1,000 rather.
966.7.
$966.7. So let's just say 967. So what would this one be?
Seven
773. Do we all agree, class? Why are we not answering now? Do we all agree?
How did you come about the 4, please?
Please read that question again. Read it again from the beginning. Are you reading, please? Check it. I want to read it.
Prime Tech PLC owns 5 machines, P, Q, R, S, and T, used in production. On 1st May 2025, management announced plans to dispose of some machines as part of restructuring. Additional information: machine P and Q were approved for immediate sales by the board and actively marketed at reasonable price. Machine R has no buyer, yet the management intends to refurbish it before selling next year. And then Machine X is still being used in production and management has not committed to sell. Machine T has a buyer, but regulatory approval is still uncertain. Details as at 1st January 2025.
Okay, let's go back to that on 1st of May. Did you see it?
Yes.
So, and I told you. Please mute. I told you that once an item is classified as held for sale, the decision stop at that point in time. Management announced that they are going to stop the assets from use and they're going to sell it on 1st of May 2025. It means that the depreciation for that current year will be from 1st of January to 30th of April 2025. You can no longer depreciate the asset once it has been classified as held for sale. And that was why when you check what we did at the A part of the question, we decided and we determined which of the assets can actually be held for sale, having fulfilled the master condition. And we said matching P and Q, they satisfy the condition. And then we move to the B part to solve the question. Now we want to determine the current amount of the asset. Depreciation cannot in any way take place again from 1st of May to December 2025. And that's where we got our 4/12. It is 4 months, January, February, March, April. You're allowed to use your hand to count January, February, March, April. That's a 4 months of depreciation. So that's why we want to determine the current amount of that asset as at 1st of May 2025. And that's what we are doing in this particular that's what we have done in the B part of the question. So we have 100 multiplied by 4/12. The depreciation for the whole year is 100, but the depreciation cannot be more than 4 months. So 4 months over 12 multiplied by 100 will give us let's say 33. 33 minus 100 will give us 967. 33 minus 1000 will give us 967. The same thing for they say Q matching Q. 4/12. The 4/12 multiplied by 80 will give us how much is this now? Will give us 80, right? Yes. And no, this one is not correct, please. What is the answer for this second matching Q?
773.
773.
773. So meaning that 27 will be the depreciation for the whole year. So 800 minus 27 will give us 773. It's as simple as that. Are we clear enough? Maureen?
Sir, thank you.
All right. So now determination of impairment loss. We already have the current amount, and then we'll compare with the fair value. So let's say we have item, then we have the current amount here, and then we have fair value less cost to sell. We said, I will attend to you. Just hold on. So we have P, and then we have Q. So the current amount of P is 967. Current amount of Q is 773. The fair value less cost to sell is what?
920.
For Q?
P.
Or P 920.
P is 920. Then for Q is what?
760.
760. Is there any impairment here? Morning. Nobody should answer. It's only morning. Me and morning here now. Morning, is there any impairment?
Yes.
Okay. So what's the impairment?
The carry
For some.
amount of
Okay. Morning, I'm listening to you.
ask me if there is impairment. I say yes, because the carrying amount is higher than the value in use and cost
Fair
to sell.
value less cost to sell.
Yes.
So because of that, there is impairment. So, thank you. What's the D? Prepare journal entries. Oh yeah. What are the journal entries for that?
The debit 47 to P and credit the assets.
Debit
also
E or
F.
L with how much? 47 and 13.
Yeah.
Credit where?
Assets.
Credit head for sale. The same value. So that's a journal entry. What was the other one? Explain depreciation treatment. Oh yeah, who can explain the depreciation treatment?
The depreciation treatment here is that from 1st January to that 1st May, it was still active, and that is why depreciation will be considered at that point, which we have done by using 4/12 times the figure. Then after that May, once the assets have been held for sale, depreciation will be discontinued.
Okay. Please help me clap for him. I really enjoyed that. That's very good. I'm giving you 1 mark, please. Take it, 1 mark for that. Very, very nice attempt. So please, that is that for that. It's as simple as if I told you IFRS is also 5 is also simple. As long as it is me that will be taking you, everything will be simple for you by God's grace. And then you are going to go there and deal with them. So this illustration 2 now, I want you to, it's an assignment for every one of us. And I want it before the end of this today, or if not, please snap it. Everybody should snap. I want to have the solution before the end of before we meet tomorrow. If I do not see solution, I will cancel the class tomorrow. Have you snapped it?
Show the requirement.
Yes, sir, the next page.
Okay, let's do this question together. Because there's discontinued operation in this question, I guess. Look at this question. Require determine the account treatment of the above, show workings where applicable. On 1st January 2025, Delta PSA hold 3 machine used in production. On 30th June 2025, management decided to dispose the machine and also its transport division. All assets met FRS 5 criteria for classification as held for sale on that date. Machine. So you have a machine X, Y, and Z, and like that. So fair value less cost to sale is this. Transport division is this. Then the current amount of net asset on 30th of June 2025 is 3 million. And the fair value less cost to sale is 2.7 million. The result of transport division January to June is 2 million, 1.4 million. So what we do is this standalone asset, you will help me to do the accounting treatments. Then for this transport division, we'll do it together now. Solution. Discontinued. So we were told that the current amount of the division as at the 30th of June was how much? 3 million. And then the fair value less cost to sell is 2.7 million. So which one now will be our cost to be attached to the discontinued operation?
2.7 million, sir.
2.7 million.
2.7 million. In other words, 2.7 million is the amount that we are going to realize from the sale of the operation. If we discontinue the use of the operation, 2.7 million will be what will be realized. Is that not so? So we have determined that. So what we now do is to go ahead and do what is required of us. Do anybody want to try this particular question? Anybody want to try?
Yes, I give us a 10 minutes. We'll come and submit it to you.
Okay, you want to try it, and before, so that if you make any mistake, it will be easier to correct, right?
Yes, sir. But it's not be submitted today, sir. Or
When? Huh?
maybe tomorrow.
Okay. But it must be before we hold our class tomorrow.
Yeah, this is it. I will try.
Okay. Oh. All right now. But I will have love. Let's just do this disconnect operation, and then we'll move ahead from there. It's not difficult though, but it's okay. Let's try. So make your mistake, and I think it will be better that way. But it's very simple.
Yes.
It's not something that is difficult to do. Go ahead. Go ahead, please. Let me just quickly explain it. You see, this disconnect operation, what you just do here is this 2.7 million, you have not yet realized it. So you have to write it in your book that you have a disconnect operation, and the value you are carrying it is 2.7 million. So the first thing that you do here is to determine the disconnect operation profit account. First of all, let's do the continued operation account. Continue operation account for the year. That's where you have to start from first. So you have we were told that your revenue is how much? 2,000. And then your expense is 1.4. Are we still together? You have all gone? Okay.
No, sir, we're still here.
Now, from this particular valuation, check the current amount of the discontinued operation, that is the transport division that is being discontinued, is 3 million. Then the fair value less cost to say is 2.7 million. Is there any impairment?
Yes, sir.
How much is the impairment?
300.
300,000.
So meaning there will be impairment here, right? Impairment. How much is the impairment?
300.
So meaning we are going to less this.
$3,100.
Said this is then our profit from continuing
300.
our
300.
profit before tax. Impairment is for somebody will ask 2,700. Is this 2,700? Okay, 3 million minus 2,700. That's how we got it. So probably before tax will be how much?
300.
This is 17, okay. That's 300. Then you charge tax. What was the rate of tax they gave us?
30%.
30%.
So what will be the tax?
90 naira.
90. So you have profit from continuing operation. How much is that?
210.
210 will be the profit from continuing the operations. So you now determine the discontinuing the operation, but because this question did not tell us that they have sold that asset, so we cannot determine the continuing operation. But what we will have just written will have been discontinuing the operation. Let me put this into the front so that it will be easier. Revenue. So that is how it is. So it's as simple as this. Then, assuming we have our discontinuing operation profit, we just write it here. But since we don't have it, just put it because we are not told if they have sold that asset. So we just write it here. Then you now have total profit. This is how to do it. Though. It's not something that is difficult. Total profit, and you put it there, and I think that does it. Any question? Are we good to go?
So we're adding the discontinued operation profit to the continued one, right?
Yes, you had it after the continued operation. Is it clear enough?
Yes, sir.
Sure. So that is everything that you need to know under this particular standard that we have just considered. It's not something that is difficult. It's something that all of us we can easily relate with any day, anytime.
You have not written profit, sir.
Sir?
You have not written the figure for the total profit, sir.
Total profit will be, since we don't have now, that's why I didn't write 210. Okay,
210.
no problem. It's all right. Okay. So that is that for that. It's as simple as ABC, and I'm sure it's very clear enough. Is it difficult? Go ahead, please.
For the discontinued operation, are we still like going to? I wish there was like a question for it or information for it. Are we to work it like the way we work this continued operation, or they usually just give us the figure?
They will usually they will give you the figure. You know, this continuing operation is actually meant to even be disclosed. It's not something that you should waste your time doing the calculation. It should be disclosed. You understand me now? But I'm just showing you that in case they bring the calculation, because I've not seen them tested it in any of the question before now, they can bring it up now. This is just how to do it. You understand now? They may go ahead to say that your discontinued operation profit, your continuous operation profit after tax is 100,000. They will now tell you that the sale of the discontinued operation is let's say 500,000. The expenses is 2,000. You remove the 2,000 from the sales, and then you have what we call the profit from continuing the operation. You understand? So just like we have what we call gain on disposal, you can also have gain on discontinued operation. When you have that gain on discontinued operation, instead of calling it gain on discontinued operation, you bring it here, you bring it under this discontinued operation profit or gain. You write it there, and then you write your total profit for the year.
So is it possible we have loss?
You can have loss, of course. You can have loss. That's why it's called profit or loss.
I'm talking about from the discontinued operation.
You can have loss, yes. If take, for instance, now, the discontinued operation, for instance, this question is 3 million. Let's assume, okay, with the impairment that we take off, is now 2.7 million. That's the discontinued operation. But then, buyer that are coming and saying, okay, we can't buy for 2.7, or we are going to buy it for 2.5. There is a loss there now. Is that also a loss of how much? 200. That 200 will be referred to as discontinued operation loss. You write it there, and you net it off from the profit for the year to give you the total profit for from continued operation to give you the total profit for the year. Is that clear enough?
Yes, sir.
Thank you. Any other question? Okay, Mr. Anamdi, you're asking me for my phone number. Just check the WhatsApp group page. You see my company name there, Casal. Casal. Once you see it on the admin, just check there. You see Casal. You see there. Chat me, DM me. I will speak with you.
Okay. Thank you, sir. Thank you, sir. Thank you, sir. Okay.
So I'm sure there are no other questions. We are good to go. The class has been fun. We have been filled. Please solve questions. Look for past questions. Deal with any what I just want to do now is go and look for past questions, anything on IAS 38 and Ifrs 5, and then demystify it. You will see how cheap they are. Thank you so much for your time again today. I really appreciate and enjoy you. Thank you so much. Have a very wonderful weekend.
Thank you, sir.